Hey everyone and welcome back to another edition of TLA. In this video we're going to showcase some of the top indicators available on TradingView tailored for price action and ICT traders. These tools assist in spotting market direction, fair value gaps, trading sessions, volatility, candlestick setups and ideal stop loss placements. If you're keen on mastering advanced trading concepts, setup strategies, entry criteria and maintaining discipline through a trading plan, be sure to subscribe to our channel and access all our free content. Catch out after this intro. Traders, don't miss our free ebook, Unlock the Entry Secrets of Market Makers. Learn how the pros enter the market. Links in the description, grab it now. The first indicator we'd like to present helps in identifying imbalances and fair value gaps on the chart. An imbalance happens when there's a notable disparity between buyers and sellers, leading to sharp price movements and creating fair value gaps between the candlesticks. Fair value gaps form in a sequence of 3 or more candles where there's a lack of overlap between the upper and lower wicks. The first reason traders seek out gaps on the chart is because they often attract price to revisit and fill the gap, rebalancing the market. The second reason is that the supply or demand causing the imbalance is seen as a valid zone by ICT traders. The price surges that generate fair value gaps usually leave behind participants waiting for a pullback to enter, so many traders aim to enter when price returns to the valid supply or demand area, provided it aligns with the prevailing trend. To apply the indicator, open the Indicators tab on the TradingView platform and search for Super Order Block. Choose the one created by Makuchaki and add it to your chart. This tool can display several elements like order blocks and structure breaks, but we specifically use it to spot fair value gaps. So go into the Settings menu, uncheck all options except FVG, then click OK. As shown, the indicator marks fair value gaps directly on the chart, which can be useful for those studying ICT trading setups, but keep in mind it's essential to understand the various Forex trading sessions to determine the ideal times and currency pairs to trade. The second indicator we're going to cover deals with spotting market sessions on the chart, but before that let me explain why grasping the sessions concept really matters. As you may know, in the Forex market there are 7 major currency pairs which are among the most frequently traded globally, giving them a comparatively lower spread than most minor pairs. We also have 3 main sessions, namely Asian London and New York. During the Asian session, assets like the Japanese yen, Australian dollar, New Zealand dollar and gold are actively traded, so currency pairs involving these will have the kind of liquidity and market movement traders look for. That's why trading something like GBP USD in the Asian session isn't logical due to a lack of liquidity. If you monitor dollar yen, euro yen and pound yen during the Asian hours, you'll notice their price action is quite alike. The reason is that the yen is the only actively traded currency across those pairs during the session and it drives their movement. However, when you look at the Aussie dollar, you'll see it behaves differently, since both the Aussie and yen are being traded actively in that time frame, leading to a clash between 2 major currencies. So for session specific trading, it's better to select a pair driven by just one active currency. The London session comes next, and it's one of the most active periods with a high volume of trades resulting in strong liquidity and typically tighter spreads. Here the pound, euro, franc and gold see the most activity, and the same logic applies when choosing pairs for this session. The final session is New York, which begins with an overlap with London. This overlap creates significant liquidity for a few hours, which is ideal for scalpers and intraday traders due to wider price swings, but if you prefer a calmer market environment, the London session might be more suited to your style. With that said, if you're unsure about market opening and closing times in your local time zones, simply type market session in the indicator search, choose the one created by Leviathan and add it to your chart. It will display the active sessions directly on the chart like this. In the settings panel, you can adjust the display to focus only on the sessions you plan to trade. Lately, AI has played a major role in technical analysis, particularly in crafting trading indicators. AI has emerged as a go-to resource for traders looking to sharpen their edge and discover more accurate and intelligent entry points. The next tool we're going to look at is a widely used AI-powered technical indicator known as Trend Checker. Using machine learning algorithms, Trend Checker processes extensive market data to deliver insights that were previously out of reach. This premium indicator spots possible price direction shifts and highlights key reversal zones. It detects institutional movements by studying trends and volume dynamics to generate precise buy and sell alerts. The Trend Checker suite includes 2 components named Trend Checker A and B. Trend Checker A appears on the main chart and includes multiple features. The baseline indicates short-term market direction. Green represents a bullish phase and red signals a bearish phase. The white line close to the baseline is the EMA, which functions as dynamic support and resistance. Trend checker B is shown beneath the chart and showcases the refined volume flow index and momentum levels. It can reveal volume-based divergence patterns that hint at upcoming trend reversals, but its standout feature is the ability to deliver highly reliable buy and sell alerts by evaluating trend, volume, and momentum. In addition, there are numerous settings available to fine-tune inputs such as ATR period baseline style and length to improve the accuracy of buy and sell signals and enhance entry precision. You can also merge these signals with the divergence from trend checker B to fine-tune reversal strategies and target higher risk to reward setups. One of the key strengths of trend checker lies in its capability to recognize market patterns and directional shifts that may not be visible through conventional methods. This makes it an effective solution for traders aiming to outperform the market. Keep in mind that trend checker isn't restricted to one asset class, so you can apply it across various markets including forex, crypto, futures, stocks and indices. The following indicator we want to showcase is ATR, which stands for average true range. It calculates the average range of movement over the last 14 candles for a specific time frame and currency pair. This setting is adjustable, so you can modify the period input from 14 to any value that suits your analysis. Now you might wonder why ATR is important. The reason is that this tool helps determine how many pips your stop loss should be set at in order to withstand normal market volatility. Typically, we set our stop loss a few pips below the swing low to protect the trade in case of a pullback. However, using a tight stop loss can cause you to exit the trade early even if your prediction was accurate. On the flip side, a wide stop loss often leads to poor risk to reward ratios. Plus, each currency pair behaves differently in terms of volatility and daily price movement, which is why using a fixed stop loss like 10 or 20 pips doesn't apply to every pair, coin or instrument you're trading. But how can we utilize ATR when setting our trades? Typically, we position our stop loss either 1 ATR or half an ATR beneath the lowest point of swing highs or swing lows. Open the Indicators tab and search for average true range, then click on the indicator and apply it to your chart. Here's a scenario. Let's say you identified this resistance level turning into support and now you plan to enter a long position after the engulfing candlestick. ATR indicates that the average range of the last 14 candles is 24 pips, so you would place your stop loss 24 pips below the low of the engulfing candle to protect against market volatility. Alternatively, if that seems too wide, you can use half ATR or 12 pips. It all comes down to your trading strategy, but ATR definitely plays a helpful role. The next tool is focused on candlestick patterns, which are simple yet incredibly significant formations on the chart. If you already know candlestick patterns, you understand that there are various types, each with its own title and specific interpretation associated with it. Now, when you go to the Indicators tab and type the name of a candlestick pattern, chances are you'll find it. For instance, searching for doji brings up multiple doji pattern indicators provided by TradingView itself. In addition, there are community scripts indicators and strategies created by other traders. You can look up any candlestick formation you want to identify, such as the engulfing pattern, and once you add the bullish and bearish engulfing indicators, they will display those formations right on the chart each time they appear. You can also load a complete collection of candlestick patterns using an indicator called All Candlestick Patterns. Once added to your chart, the settings allow you to enable or disable any specific candlestick pattern from the list, and as you'll see, it's quite an extensive selection that covers nearly every known pattern. Alright folks, I hope this video offered some useful insights. If it did, please leave a like to show your appreciation, and don't forget to subscribe to our channel if you haven't already. We'll catch you in future episodes.